And then finally, the fifth assumption is the periodicity or the time period assumption. And it basically states that as a going concern, the information of a company's life is broken down into shorter time periods. And these shorter time periods can vary, but usually they're either months, quarter years. So this would be 3 months, 3-month periods, or full annual periods, full years. And this assumption helps with a lot of those qualitative characteristics of financial information. It allows the financial information to have those qualities. So there's a bunch of reasons why. One reason why is that a lot of companies, they actually have like a certain operating cycle. So for example, we may have a company where at one part of the year or one part of the period, the sales are high and then they kind of dip down and then they get to this here, to the end of the period. So here's the start, here's the end. And then again, the sales go up and then they maybe dip. Not all companies have this, but a lot of them do. They have certain operating cycles. And so if we can break down all of this into shorter time periods, so right here and then right here, external users can then look and compare the company perhaps in those specific time periods. So when the sales are doing well, how are those numbers comparing from period to period? Or when the sales are low, how has the company been handling those downtimes, right? Have they been improving in handling the downtimes or not? And then you can even take this whole period here, you could break it down further. You could get even more specific, right? So it helps external users compare the different operating cycles, so it makes the financial information more comparable, which is one of the qualities we're looking for. It also helps with timeliness and relevance, because let's say that we're here in this period of time. Which of these cycles is going to be more relevant to us, more useful? Well, the more recent one. Right? As I've said when we talked about timeliness, is that older information as time goes on becomes less and less relevant. And so splitting it up into these shorter time periods allows you to look at more relevant information. Right? So breaking it up into these time periods, it just helps with a lot of those qualities that we're looking for financial information to have. However, this assumption also brings up a lot of issues as well that we're going to be covering in this course. And the biggest issues is when to actually recognize revenue and expenses. So for example, let's say that you're selling a product, and let's say that you sell it in November, and you sell it for $1,000 to a customer. But the customer doesn't pay for the product right away. Let's say they pay for it in January. So that's when you receive the cash. $1,000 cash, and that's when the money goes into the bank account. But you gave the product or the service to the customer here in November. And let's say that your company, its annual period finishes December 31st. When do you recognize the revenue? Do you put the revenue on this annual period's financial statements or on this annual period here? Right? So that's an example of an issue that we're going to go over. And it could even get more complex. So let's say in November you sold a $2,000 product instead. You didn't receive cash here, but you gave the product or you gave the service to the customer. And then in December, they pay $1,000 cash. And then in January, they pay $1,000 cash. When do you recognize revenue? Do you split the revenue up here because of this cash, or do you recognize it here, that full $2,000? So that's an example of an issue we'll run into. And it doesn't necessarily just have to be 2 months. So let's say that you're a car dealer and you're selling a car in November, and then someone's going to be paying off this car over a couple of years every month or let's say even every 2 weeks, making bi-weekly payments. What happens then? How do you recognize that revenue? Or you could be on the other side of the transaction. Let's say that you're going to be leasing a car for your business and then making monthly payments for a couple of years. How do you recognize that expense? Right? So that's stuff that we will be covering in future videos in the course, but thought I would mention that. So this assumption, even though it helps with a lot of the qualities that we're looking for financial information to have, it also brings up a lot of issues.